Hello, my name is Will Chandler, and welcome back to Mazuma Pro Money Matters. So, today I'm going to share with you some things you need to know about your credit, what affects it and what does not, what it hits it hard, what hits it soft. But before we get started, make sure that you hit that subscribe button down below there and then click the little bell next to it so you're notified every time we upload a new video. So, stay tuned. Brought to you by Mazuma Pro, a lifetime money plan. Welcome back. So, credit reports, they don't care about income, they don't care about where you live. They only contain information about money you've borrowed and debts that you owe. So, getting a better job or getting a raise, that's not going to increase your credit score. But there are certain things that do affect it and don't affect it, and some more than others, and we're going to discuss those right now. So, the number one thing, on time payments. It has a very high impact on your credit score. As you would expect, someone's going to loan you money, they're expecting the money to get paid back, and they're expecting it to get paid back on times on the terms that you agreed to. Now, with that said, there is a little leeway that a lot of people don't know about. So, if you make the payment 2 or 3 days late or 2 or 3 weeks late, you're not going to have an impact on your credit score. What? Did he just say that? Yes, he did. You can make a late payment and it not affect your credit score. But keep in mind that if you pay a payment a day or two or a week or two late, your creditor probably will charge you a late fee, whatever that late fee may be. But they cannot report it to your credit report until you are 30 days late. Did you hear that? 30 days late. So if you're a little tight and you need to be a little late or something, it's not going to affect your credit. You can pay that payment 29 days late and it won't affect your credit. Once you're 30 days late, it's going to affect your credit. Do not go 30 days late. That is a very high impact on your credit. And once you have a late credit on an account, the only way to get rid of it is to close that account. Then that late payment will fall off in 5 to 10 years. So, number two, credit used. Again, a high impact on your credit score. So, the more percentage of your available credit that you have used up, the lower your credit score is going to go. Let me give you an example on that. Let's say you have two credit cards and both of them have a $5,000 limit. Now, one of the cards you've charged all the way up to $5,000, and the other card has a $0 balance. So, in the eyes of the credit report, you have $10,000 of credit available and you have $5,000 used. You've used 50% of your credit, which isn't a good thing because the standard is staying less than 30% of your available credit. And even better than that, staying less than 10% of your available credit. But back to our 50%. So you decide that you're going to close one of these accounts. So you close the account that has zero balance. And so now that's gone because you think, oh, I get rid of this credit card, my credit score will go up. Well, here's what happens. So you had $10,000 of credit and used 5,000. So now you've just closed the credit card. So now you have $5,000 of credit and you've used 5,000 of it. So now your used credit is now 100% of your potential available credit. That is bad. When you get to 100% of used credit, your credit score is going to take a dive. It's going to nosedive right off the cliff and it's going to go, go, go. The only way to get that back is to get more available credit. Pay it back. So that has a high impact on your credit. So now the third thing, the oldest credit line. So how old your credit is a factor too. Now this is a moderate impact. It doesn't have the same impact as used credit and missed payments, but it does have a moderate impact. So you want your credit history to be as long as possible. So Do not close your oldest credit account and do not let that go bad. So, the oldest and the best is what you want to keep because you want it to have a long, long credit history. You want to get into the decades, over 10 years and even still over 20 or 25 years of credit history. That way you have a long, long history with using credit, and then lenders will be a little more, thinking that you are educated on how to use credit and you use it wisely. So, oldest credit line, keep it good, keep it open, and get that length of time way extended. So, number 4 on that, recent inquiries. You don't want too many recent inquiries on your account. Now, if you're shopping for a mortgage or a car loan, that's a little bit different because chances are you're not looking for 5 mortgages or 5 car lines. You're looking for one, So lenders look at those a little bit differently. That way you can rate shop your mortgages and stuff. So don't let your mortgage broker tell you that, hey, it's going to impact your credit. If you go to 2 or 3 or 4 mortgage places, then it's not going to affect your credit. But on the other hand, if you go for revolving debt, which is credit cards and lines of credit, stuff that the balance can go up and down, then that's different. If you get 3 or 4 or 5 inquiries on credit card accounts, revolving accounts, now that's going to impact your score a little bit more. It doesn't have as much of an impact as the oldest credit line, and not nearly as the used credit and on-time payments, but it will impact your score. It'll go down a little bit because the lenders will be like, hey, wait a minute, this guy is looking for a lot of credit. Maybe something's up with him. Okay, so recent inquiries has a low impact on your score. Keep it down to a minimum. Every 2 years, they start to fall off. So within every 2 years, only keep the inquiries to a minimum. So number 5, and this is also a low impact on your score, new accounts. Don't open up a bunch of new accounts at the same time or in the same period. Again, if you open up a car loan or a house loan, those are one thing. But when you start opening up 2 and 3 and 4 and 5 credit cards within the same little period of time, lenders are going to be like, hey, wait a minute, what's up with this dude? He's fixing to go over the cliff, right? So we better be careful with him, and your credit score is going to take a hit for it. Again, not as big a hit as payments, but it will take a hit. You open up a lot of new accounts, they're going to be like, hey, what's this guy doing with his money? So be careful with the amount of accounts that you open. Number 6, available credit. So you want to have as much available credit as you can. Even if you haven't used a lot of the credit, you want to have available credit. Now, excellent available credit is like over $50,000, right? But you want to get to where you have like $10,000, $20,000 of available credit, and then you get up into the good range, and then it's not affecting your score negatively. But if you have less than $2,000 of available credit, it's gonna, they're gonna be a little iffy on it because you don't have much credit available. So any kind of little problems and you're overstretched, and you're just not gonna be able to make it. So available credit is a good thing. The more available, the better. But if you have that available credit, don't use it down to nothing, right? So 6 things that really, really affect your credit score, and it's not income and where you live, is number 1, on-time payments, very high. Number 2, credit used, very high. Number 3, your oldest credit lines. That's a moderate impact. Number 4, recent inquiries. It's a low impact. Number 5, new accounts. It's a low impact. And number 6, available credit. It's a low impact. You keep those things in mind, and then you can work your credit, and then you can eventually make it better. So, in closing, I want to say that credit is a dangerous tool. If you do not understand how it works, and if you're not disciplined about it, and if you use it to buy just your everyday stuff and you don't pay it off every month, it can snowball out of control before you know it. Then you're looking back saying, hey, how did I get all this credit card debt? Well, you've piled it up. Your debt's piled up, your credit score went down. So when you really need something, you won't be able to get it. So By being credit savvy, you can save lots of money in fees and interest just by having a high credit score. And you can make sometimes getting an emergency purchase way easier. So, if your credit score is low, don't worry about it. Be sure to hit the subscribe button below and then tap the little bell next to it to get notified when our video on how to raise your credit score is uploaded. Stay tuned and thank you very much.